Thanks again for the invitation to present the paper, and I will be talking to you about ESG as many other papers in this session, and I will, building up on what Laura said, there's different flavors of SRI and ESG in the sense that there will be screening, there will be other forms of integration, so we'll look into all of that. But there's also concerns that of greenwashing, meaning that investors may be pretending to do more ESG or responsible investing than they really do. And this is just some clips from media. Recently, Europe's launching some new rules to avoid greenwashing. The new incoming SEC chairman is also putting that as a policy priority, and so have been talks in Asia about properly getting ESG fund labels and so forth. So that's kind of the motivation we're walking into this, as Lauren, building up on the previous presentation, is there's a, anytime you look into this space, you see bigger and bigger guess estimates of how many dollars are deployed into ESG or responsible investing. We are going to look into perhaps the largest network here, which is called the Principles for Responsible Investing. At last count, when I last looked at their website, they had over 3,000 signatories, 100 trillion in asset. And the question is, what is really, how much of that allocation is really ESG? And does it eventually lead to different outcomes? So there's really an agenda here for many things going forward. Many of the people in today's sessions and many others have contributed to this, but I think as an academics, we're still at the shortcoming in terms of our understanding of this. So Laura has some work, as well as Elroy, who present that work later. Laura, for example, has run a survey which came out in the Review of Financial Studies on what investors say they do with respect to climate. Some of the other work look into investors' portfolios. So what we do new in this study is we're going to combine the two, what investors say they do, or their investor policies, and which we will get from a survey from the PRI, with the archival portfolio data of their filings, meaning the actual portfolio footprints or ESG metrics of their actual equity investments. And ask the question, do the claims they make on these surveys as they respond to, as they put out to the public their commitments to ESG, do they really translate into actual outcomes in their portfolios? So the first question we ask is who's committing, and in that we find that there's more PRI signatories outside the US than in the US, but every asset investment manager that is big these days has already committed to PRI. So as I will show you, everyone that's large, less so if you're smaller in size, in AUM. That's perhaps a more descriptive question. The more research question here is, do the commitments translate into actions? So do people walk the talk? And the institutional investors around the world walk the talk. And here we find that on average, PRI signatories have better ESG portfolio footprints, and I'll explain what that means in a second, but less so if they're in the US. And interestingly, we'll actually document some greenwashing by some signatories. And we will able to dig in on the actual strategies they use to implement, whether it's screening, as we discussed in the previous paper, whether it's integration more holistically, and thematic investing, as Lauren was being asked about, like green investing, or water funds, etc. So we'll walk through all that, and then we'll drill down. Why is there a gap in implementation in the US? And why do the US PRI signatories have actually worse scores than non-signatories, meaning the other US institutions? And why is there less in other parts of the world? So our explanations, our results suggest that it is driven by a drive by US money managers these days to drive flows particularly if they're targeting retail clients. This phenomenon will be less present if they're monitored by institutional clients, by separate accounts, etc. And if they themselves have issues on their operations. Some of the US signatories are not, late to the game, if you like. They're pretty late in terms of signing these pledges. Then they tend to be located in states within the US that are less more moderate to right on the political spectrum, and the motivation, as I mentioned, was higher flows. And so that's kind of the plan. I will briefly mention the data. So the principles for responsible investing came about in 2006. And the first principle, the founding principle, is to incorporate ESG, to be active owners, etc. For us, the most important principle is principle 6, to share data on reporting yearly how much progress they've done to implement these principles. There's a large proportion of them, overrepresentation of European signatories and underrepresentation of US, but it's all over the world, and we'll study that then by looking at their filings, the equity portfolios disclosed to regulators around the world, and then we'll build up with those filings. We'll measure the ESG performance of the stocks in investors' portfolios by taking a combined, an aggregate score that doesn't overweight any of the individual data providers, but we'll take Asset 4, which is now Refinitiv, Sustainalytics, and MSCI to do that. So the core thing from PRI that comes to us is, one, when did the signatory sign? So for example, BlackRock signed in 2008, and then subsequently, what do they report on a yearly basis? And there's a lot going on, as you heard before in the previous question, on project finance. There might be fixed income, etc. What we look is only into the listed equities part of their portfolio, which is these modules, listed equity direct and listed active ownership. And for example, BlackRock reports, I know it's very small on your screens, but they report that on 68% of their portfolios they don't implement, but on 30% they do integration, and they do a minuscule part, 4% on screening. And so that's kind of putting the all data together, is taking what they report to do, whether it's BlackRock, Bernstein, for example, Korean National Pension Service, the Norwegian Sovereign Wealth Fund, all of them. Then we look at their portfolios, like Bernstein has Volkswagen, Novartis, and Exxon, and then we compute an aggregate portfolio score, which we call the ESG footprint. Those are the signatories. I've mentioned some of them already. And in interest of time, just moving along, this movement started in 2006, and it's grown both in number and also as a proportion of the total AUM. More interestingly, it's grown much faster on the chart on the right, which is the outside the US. You see more of the green, the PRI signatories, as a proportion of the AUM of the total institutional ownership around the world. But it has picked up in the US, and now over half of the AUM of institutional investors that we pick up from FactSet ownership has now pledged to the PRI principles. So this is the first research question I promised. We looked into, do the signatories and the non-signatories differ in terms of the ESG footprint? And what we find is, as you see from that density curve, is the signatories tend to underweight or chop off the bad ESG firms, those firms that have lower normalized scores in terms of the three data providers. We also looked into each individual one, Sustainalytics, MSCI, and Asset 4, and we find the same result. And then, so the greens tend to sort of chop off that left tail, and they overweight better ESG scores. Now, this is just a picture. We can control for, of course, the more apples to apples comparisons by taking into account that, there's PRI signatories from all over the world. So we take into account their geography, their size, and the other portfolio characteristics, the horizon, etc., that have been documented in prior work to matter. And so our coefficient of interest here is the PRI dummy, a flag, whether you have signed the pledges or not, and we find that on average the PRI signatories have better scores. But when we break down the subsample of those signatories that are in the US domiciled and non-US domiciled, we find the difference only shows up outside the US. And then if you look at the top panel, which is the US, there's actually sometimes negative loadings on that dummy, which means that the signatories actually have worse scores than the non-signatories. And then we look, which I will not show you, at diff in diff specifications, where we look at BlackRock, let's say pre-08, past 08, to look at the same entity before and after, and we find the same phenomenon, that US signatories don't seem to improve, but outside they do. So what is new in this this study, beyond looking at the PRI signatories, is then using the PRI survey itself to document different strategies. Do they choose differently the stocks they buy, which is asset allocation decisions of chopping off the negative screening that we heard from the previous paper, of tobacco, oil, etc. The positive screening, the overweighting of those that have better ESG metrics, or thematic investing. That second strategy, thematic, is setting up funds on targeting water or green energy, etc. That we show is minuscule or still niche compared to screening. Screening is more prevalent than thematic, and the most dominant is actually integration. Integration is maybe loosely defined as changing the whole investment process from doing the valuation to picking securities to managing your portfolio, to risk management, to incorporate ESG metrics, and that is the most pervasive. That's what we focus in this paper, but you will hear Elroy Dimson's paper later on, also from PRI on the engagement side. So once you bought the stocks, do you want to change their ESG practices by engaging with the portfolio firms? We will not look at that in this. But what we immediately find is there's a disconnect between US and outside US, in the sense that there's less ESG incorporation, even what's disclosed through this PRI survey. And outside the US, there's a higher prevalence of signatories that disclose to apply 100% ESG strategies to 100% of their AUM, and also those that still do some partial incorporation. Then when we run the same tests, now breaking down the PRI signatories that do full, partial, and no ESG or unreported yet incorporation, we find, interestingly, the problem in the US is concentrated on those signatories that have not been disclosing how they actually do the ESG incorporation, and those we label as greenwashers, and loosely using that word. Interestingly, outside the US, which is the bottom panel, you see that there's a large alignment between words and actions, in the sense that those that have reported full or partial integration have better ESG footprints than the non-signatories. We also look into other ESG metrics, which I won't spend, but like the SIN stocks, or we talked on the previous paper, and the results are consistent there. So now, finally, in the last couple minutes here, before Faye asked me to stop, is why is there a disconnect in the US? I'll go very quickly. When we break down the US signatories that greenwash, we find those that do so tend to have poor performance. Their client base tends to be more retail. They have to have operational issues. They tend to be late joiners, and they are more based in moderate to right-leaning states in the US. Why do they do this? We run some tests on flows. So we see AUM growth if there are become signatories, and even if you sign but do not walk the talk, that you are rewarded with investor flows. And if it is an issue with fiduciary duty that's come up in the US on ESG incorporation, we don't find that this is actually because these signatories have better performance. We don't find that to be true. And then we have some other tests on the disconnect between Europe and or other parts of the world and the US. I'll stop there to also highlight that we find no convergence of the signatories in the US to over our sample period. And so in summation, to conclude, we offer first evidence of data on survey data on ESG incorporation strategies, and then look into the portfolio level. And we have these two findings in the US. There's a disconnect between the commitments and the actions. Outside the US, they're more aligned, but I think there's still a lot of future research to be done on why is there a disconnect in the US implementation of ESG. So thank you. I look forward to Alexander's discussion.
Thank you so much, Pedro, for a presentation that packs lots of information. Our discussant is Alexander Dyck from the University of Toronto. Alexander, floor is yours.
Thank you so much. So I want to thank the organizers for including me, and I've always learned a lot from the papers that the authors, from the authors of this paper, their prior work, and this paper is another example of some excellent work. Let me just to start, review what the paper really does. And it really kind of explores questions, I would say, in two main areas. One contribution which Pedro didn't emphasize, which is around fund flows, and that's the question, does committing to the PRI increase the fund flows from the owners to the asset managers? That's an important question. It's a question the paper addresses. Second question is around the ESG portfolio footprint. Do the PRI commitments affect something real in terms of affecting the ESG footprints? And they make contributions in both of these areas. To the first question, they provide some yes, and I would say a non-nuanced answer, which is very clear that owners appear to believe the commitments when they join the UN PRI that you're going to be a responsible investor, and fund flows go up. It's new international evidence that adds to the stock of evidence that we have. It's new evidence that this core signal of joining UN PRI is really going to drive fund flows, and there's evidence that owners don't appear to differentiate between the strength of the commitment, someone that signs up for the UN PRI and actually does nothing, versus someone who signs up for the UN PRI and does a lot. So I think that's an interesting, that there is a value to the asset managers from making this commitment. The second contribution is around the ESG portfolio footprint, and I think that Pedro summarized this well. But let me this is more of a nuanced yes to this question, that we see that those who sign up to the UN PRI tend to, on average, be sort of better from an ESG footprint, and more importantly, that the signers increase their ESG footprints. I say it's a nuanced answer because those results really only show up if you take a look at the rest of the world. And if you look at the US, we find that US PRI investors don't have a higher footprint, they don't increase their ESG footprint, and some have a distinctly lower footprint. So I think the paper appropriately then spends a bunch of time on, let's call them the weird US results. And the weird, and then it's harder to reconcile with our understanding of the way the world works. And the authors provide evidence to say that, is this simply, they call it rainbow washing rather than greenwashing, because ESG has more than an E component to it. And they say, yeah, that's what they're doing. And then you saw the results that Pedro emphasized from table 7 in the paper, with kind of a weak conclusion at the end, is maybe because there's more competition in the US markets. So my job here is to, I'll mention a couple things I like, and then of course my job is more to raise concerns. Around the things I like, I just have to, just congratulate these authors. They've put together some awesome data. They presented carefully and clearly. You learn a lot. I'm already using it in my presentations. So I want to thank the authors for doing that huge amount of work. I understand why there are 5 authors. This is not an idle task to get this UN PRI data, to match it with institutional holdings, to match it with ESG footprints on a portfolio level. Second thing, just want to understand that this is better data that corroborates and extends a number of prior findings out in the literature. So it really is complementary to the work that's been done out there. And by this, there's some earlier work that I did with some co-authors around pointing out the difference between US and non-US investors. There's the fund flow evidence. There's a really nice paper by Hartzmark and Sussman that shows when Morningstar came out with a rating of asset managers on how good they are on ESG issues, significant change in fund flows. This is new international evidence with a coarser signal. And there's the survey data that Pedro made reference to that Laura and some of the co-authors on this paper were involved with. And this really provides some real evidence rather than just survey data that corroborates what was done there. So this is excellent. And again, I think appropriately the paper seeks to explain I call them weird US results. My concern suggestions are in 3 areas, and there are only 2 that I'm going to spend time with you talking about. The first one is I think the US explanation results need more refinement to be compelling. They've tried, it's hard to explain, and I'm not sure they're quite there yet. My suggestion is that one way forward might provide more of a theoretical framework that I would think would give guidance and more to test and interpretation. Quibbles on data and coding, I'll just leave to give to the authors and not bother all of you with. What do I mean by the US tests could use additional refinement? I think there could be some more clarity for some tests. So one is there's just too many answers. What I mean by too many answers is really like your table 7 results, which says, why is the US different than other things? Well, there's 5 different possible explanations. We'll show you evidence for all of them. And as a reader, I'm left going, well, I don't quite know what I did learn from that, except to say that all of them are possible. This is where I think a theory would help to give us guidance as to which rationales to focus on. And some are just confusing. End of the paper, they've got table 10. It's an excellent set of tests, but I'm not quite sure what I conclude. I'm not sure quite what the authors conclude from these tests here, where they say, well, values seem to matter for ESG footprints. They don't explain everything. So it might be driven by a strong focus on commercial reasons. Well, it might be, but it could be 100 other reasons too. Like I don't quite know that's what we conclude from this. I would say that there are also some missing tests. And by that, I mean, the rainbow washing result is not a surprise to me. The result that's a surprise to me is why doesn't everyone in the world sign up to the UN PRI if it's going to improve their fund flows? And they don't have to do anything about it. So to me, more of the surprise is why don't non-US investors that don't do anything on ESG pretend they do and just sign up to the UN PRI? Because it seems the US guys do it with no penalties whatsoever. So that's the missing tests. And then there's also exploring the importance of fiduciary duty obligations. And there is a difference between the US and Europe. I don't know why they don't take advantage of different types of investors to get some more clarity on these questions. I think it could be done. We did it in some of our prior work. My main suggestion is just one thing, a little theory. And I think a theory based on signaling could really help you frame and refine your tests. And many of us here are at universities. Let me just use the university setting to frame ideas. So imagine that there's employers trying to hire workers who differ in ability. Employers just don't have a good signal of ability. What to do? Then all workers get paid the average level of ability out there because all are going to be pooled together. If we could figure out some great idea of a costly to fake signal that able employees could get, they'd be able to separate themselves from the less able, earn higher wages. Employers would be happier to pay these people that are higher ability. That's what university education does to the extent universities have hard tests that are easier for able people to do than non-able people to do. This simple story moves us from creating this signal. We go from a pooling equilibrium to a separating equilibrium, and it explains why this well-noted effect of a premium to higher education. And again, the importance of this signal is it's not what is taught, it's not what we do at school, it's the fact that we're able to separate out the able from the less able. Is the UN PRI a costly to fake signal? I think the answer to that is both yes and no. What Pedro mentioned, what does it take if you sign up to be a UN PRI signatory? You have to sign up to those 6 principles that are listed here. And you have to report, and that's the data that Pedro takes a look at. But what he didn't talk about, which is what is the penalty if you don't report or you report that you do nothing? And as far as I can tell, there's absolutely no penalties for either not reporting or no penalty or reporting that you do nothing. It was only in 2018 that they started having a watch list, and only in 2020 were they going to blacklist companies. That means that for the whole sample period that Pedro was looking at, there was effectively no enforcement of the UN PRI, that you actually had to do what you said. And so, this is what the minimum requirements are. And in fact, there's not really good public data if you look at UN PRI on whether people were really walking the walk or not. So my understanding then of the data is really a simple one here. Pre-2006, there's no good signal of quality of asset managers. They're all pooled. UN PRI comes into being. They create this, what is perceived to be a costly to fake signal. People see whoever signs up for the UN PRI must be good on this. We'll send some flows to that. Then what people realize is that it's actually not a costly to fake signal. It's an easy to fake signal because there's no penalties and everyone signs up. So the Americans learn, they all sign up, they get this stamp of good approval, fund flows come in and they face no penalties. And so so then the questions are maybe like, why don't all irresponsible investors should rainbow wash? And it also suggests a focus to tests like table 7. It says early versus late is absolutely critical because the early guys are going to be different than the late guys. It suggests that we should have retail as opposed to institutional clients because the retail guys won't be able to figure it out and the institutions will. It also suggests papers should really explore why UN PRI in the end seems to have little enforcement. So let me finish up on that. Why is the UN PRI signal easy to fake? I think for the same reason lots of us at universities don't do our jobs well. Why don't we kick out more students? We kick them out, we lose fees. These guys get a lot of fees. And it's very difficult. The second reason is we become member service organizations. We forget that one of our huge value adds is to be standard setters. And I think it's very easy for the UN PRI to fit into that role, which becomes a question I think the authors would be interested to ask. Will the UN PRI become a valuable signal again, and thus a meaningful driver of change for responsible investing like it was in the past, or is that game done? This paper is really the fact that fund flows exist, even if you're terrible at doing this, is a big problem for the UN PRI, I would say. Now, they've got current proposals that say they're going to up their game and be much more rigorous. But if I look at these proposals, they mean they should kick out BlackRock. And I just don't believe they're ever going to do that. And so I remain to be convinced the UN PRI will meaningfully tighten. And what does suggest that, Pedro, you would do a service if you listed all of the investors and whether they did something or not, because I don't think the UN PRI is going to do that. And it suggests, I think, that other standard setters are likely to become more important, such as Morningstar, that are going to have a more rigorous signal. So that's it. I'm done. I've got zero time. A well-written paper shows the scope for the constructive role of the UN PRI and also shows limits with member-led organizations. Thanks for giving me the time to discuss it.
Thank you so much, Alexander. It pains me to stop these great discussions, like Alexander's and Laura's. Pedro, do you have a minute to respond?
Yeah, first to thank Alexander. Also, some of the results I was showing were fairly recent, and we will only be posting this after going through this iteration again. So this is extremely useful, Alexander. And thanks for providing that framework, which we can incorporate the theoretical framework, which I think is very useful. To your questions of no penalty, the pooling equilibrium, and the easy to fake issues, I think this is part of the, to put these surveys out and allowing academics to run the studies is one of the efforts the PRI are doing in some way. We can go one step further and list the investors. There might be some liability issues for my university, but maybe I will stop there. And I also wanted, in case I don't get there, to thank Philip and Tom for answering all the questions they've been doing on the Q&A as well. But Alexander, thanks so much for all the feedback. This is extremely useful as we revise the paper.
Thank you, Pedro. You know, we have so many questions in the Q&A box. So I'll just maybe handpick just a few so that we can still remain relatively on time. So there's a question on PRI signatory assets, including double counting of asset owner and investment manager portfolio, and make sure that you filter and be aware of this. And there's a lot of greenwashing in the reporting by these funds.
Yeah, on the first one, we try to as best as we can. So if it is under direct versus indirect, so if it's outsourced by an asset owner too, that it wouldn't be counted in. But we've also have, matched that carefully with the line shares data. So for example, an asset owner that outsources then the 13F filing, which is the US equivalent of the institutional holdings, that is typically by the investment manager rather than so we went through that a little bit painfully to figure out if there's any issues of double counting, but we can definitely explain that a little bit better. The greenwashing is what we're after at the end of the day. We, but as Alexander pointed out, Sustainalytics, MSCI, and Asset4 are not the truth by any means. There's many papers about ESG rating divergence. What we're trying to get is the kernel or the average truth, if you like, or the different truths by different rating providers, and see the portfolios. If that's exactly the research design here, is to see if the portfolio look different for the signatories or not. And more importantly, I think we go one level up, because we not just look at whether you sign or not, but what you report to incorporate, the different strategies that you use, the screening, the integration, and all, to see if you are or not incorporating. I see Faye, maybe we're running low on time. I'll hand it back to you. Yeah.
And again, I apologize that we're not able to get to even close to most of the questions.
Thanks for all the questions, by the way. We'll try our best to answer them as we
Terrific.
go.